Today, markets versus gravity. Gravity wins. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, once again, US stocks ended lower on Tuesday after another volatile session, as investors await the outcomes of the meeting of the Federal Reserve officials. The Dow Jones Industrial Average was down 0.19% at around 34,297 after dropping more than 800 points at its session's low. And of course that followed the 1,000-point swing on Monday. On Tuesday, the S&P 500 fell 1.2% to finish around 4,356, while the NASDAQ declined 2.3% to close around 13,539. Now, wealthy investor Mike Novogratz says the days of making easy money on Wall Street are coming to a swift end, and he sees more pain in store for stock market investors in coming months. I look at the stock market and it is just starting to correct, and that worries me more, he says, adding, when referring to crypto, I'm still a true believer, but it is time for sobriety. And he told attendees of the iConnections conference in Florida on Tuesday that the average rich guy is going to be less rich by the end of 2022 than he was at the end of 2021. Of course, the Federal Reserve kicks off its two-day meeting on Tuesday, and investors will of course be watching what the Fed will be saying. Let's see whether he continues to address the risks of inflation, whether they are heightened risks, and what the communication will be about the ending of tapering early or indeed interest rate rises. John Luke Tyner, portfolio manager at Aptus Capital Advisors, said if the Fed hints of any plan of how they'll use the balance sheet to reduce accommodation, that is going to be huge. But inconveniently, the International Monetary Fund has just downgraded its global growth forecast for this year as rising COVID-19 cases, supply chain disruptions, and higher inflation hampers economic recovery. In its delayed World Economic Outlook report, which was published yesterday, the IMF said it expects global gross domestic product to weaken from 5.9% in 2021 to 4.4% in 2022, with this year's figure being half a percentage point lower than previously estimated. The global economy enters 2022 in a weaker position than previously expected, the report says, highlighting downside surprises, such as the emergence of the Omicron variant and subsequent market volatility since its October forecast. The revised outlook is led by growth markdowns in the world's two largest economies, the US and China. The US is expected to grow 4% in 2022. That's 1.2 percentage points lower than previously forecast as the Federal Reserve moves to withdraw its monetary stimulus, even as supply chain disruptions weigh on the economy. The updated outlook also removed President Biden's signature Build Back Better fiscal policy package from its baseline projection after failure to pass the original bill. China, meanwhile, is predicted to grow 4.8% this year, down 0.8 percentage points from earlier estimates, amidst disruptions caused by its zero COVID policy, as well as projected financial stress among its property developers. And elsewhere, still surging COVID cases, coupled with rising inflation and higher energy prices, weigh on growth estimates globally, most notably in Brazil, Canada, and Mexico. And the IMF said higher inflation is set to persist for longer than previously anticipated, but added that it should ease later this year as supply-demand imbalances wane in 2022 and monetary policy in major economies responds. It has yet to wake up to the fact that inflation is embedded and wages growth will probably follow, stoking even more inflation, but we'll see. Looking ahead, the report upgraded its 2023 growth forecast by 0.2 percentage points to 3.8%, but it warns that the estimate precluded the emergence of a new COVID variant and said any pickup would be dependent on equitable global access to vaccines and healthcare. The forecast is conditional on adverse health outcomes declining to low levels in most countries by the end of 2022, assuming vaccination rates improve worldwide and therapies become more effective, it said. The emphasis on a global health strategy is more salient than ever, it added. So the Federal Reserve is under the gun as the market plunges ahead of its first rate-setting meeting of 2022 against a weakening economy, and as at least one star money manager says, the central bank could be making a policy error by focusing on raising interest rates. Scott Minard, Chief Investment Officer at Guggenheim Investments, said that the Federal Open Market Committee needs to focus on shrinking its roughly $9 trillion balance sheet, which he argues has fostered anomalies and bubbles in asset markets. For all the hoopla about the Federal Reserve raising short-term rates, policymakers may be missing the best opportunity since the great financial crisis to normalize monetary policy, he said. Market-based projections imply that the FOMC will lift federal funds rates, which currently stand at a range between 0 and 0.25%, at least 3 times in 2022. And other economists and market participants are predicting a more aggressive plan for rate increases by the Fed as it tries to douse a surge in inflation that has been at least partly born of supply chain bottlenecks, labour shortages, and a pickup in demand as consumers try to emerge from COVID-induced lockdowns. Minard, however, makes the case that the Fed should be fixated almost exclusively on a reduction of its balance sheet, which currently stands at around $8.7 trillion. And currently the Fed continues to expand its balance sheet despite all the hype and talk of tightening. Minard says that reducing the overall balance sheet, which has contributed to inflated values in everything from stocks to cryptocurrencies such as Bitcoin, could be managed better by pulling back on the supply of liquidity which the market has enjoyed. Changes in money supply are a powerful driver of economic output, asset prices, and inflation, he said. Interest rates are the byproduct of monetary liquidity, economic output, and inflation expectations. Short-term market rates can be manipulated through changes in the stock of money, he wrote. Minard said that one of the negative ramifications for the size of the Fed's balance sheet was the reverse repo rate, a key artery of global financial markets. The Fed's reverse repo program lets eligible firms like banks and money market mutual funds park large amounts of cash overnight at the Fed at a time when short-term funding rates have fallen to next to nothing, and where finding a home for cash has become harder. The program had almost no participants in early April at last year, and few since the pandemic's onset in the spring of 2020, but demand surged in May 2021. That facility now has daily volumes of around $1.5 trillion, writes Minard. Any program to raise rates will require the Fed to raise the rate of interest paid on RRP operations by the amount of the increase in the overnight target rate, he says. In essence, the Fed will establish an artificial rate which is not set by market forces, he said. In other words, the free-flowing liquidity has created artificial levels for rates that aren't driven by market forces. Minard says that without the ability to accurately discern the state of the market through mechanisms like the RRP, the Fed is essentially flying blind. Without market forces, the Fed will have no ability to recognize what the true demand for money would be if interest rates could freely float, and thereby create a signaling mechanism to indicate the true equilibrium rate of interest, he writes. Minard said that raising rates dramatically would destabilize the financial system and railed against suggestions that the Fed should focus on shock and awe tactics by delivering a hike of 50 basis points rather than 25 basis points that the markets are pricing in. Economists are, in fact, expecting the Fed to reduce its asset purchase program, ending that program as early as March, lifting interest rates as many as 3 times and winding down its balance sheet. Minard would encourage the Fed to focus on its balance sheet. He says that controlling the growth of money supply may be more influential in resetting policy and a better tactic for the central bank than interest rate increases. Nevertheless, in anticipation of a hawkish tone on policy from the Fed, US bond yields were on the rise, with US 10-year yields briefly flirting with 1.8%, boosting rate-sensitive sectors like banks. Discover Financial Services and American Express led moves higher in financials on Tuesday, with the latter receiving an additional boost after delivering quarterly results that beat on both the top and bottom lines. American Express reported better than expected quarterly earnings of $2.18 per share on $12.15 billion in revenue. That's well above Wall Street estimates of $1.87 and $11.5 billion respectively. Why? Because credit growth is still strong. But of course that is not necessarily healthy. Energy, however, was the standout performer, rising more than 3%, underpinned by fears about potential supply disruptions as geopolitical tensions in Eastern Europe and the Middle East continue to rise. The gains in the cyclical stocks like energy and financials contrasted with losses in growth sectors like tech, which could continue to trend lower amid a rising interest rate environment. That said, Microsoft, which reported after the close, said sales topped $50 billion for the first time in the holiday quarter of 2021 and easily topped earnings expectations, but the shares still fell in late trading on Tuesday. They reported fiscal second quarter earnings of $18.8 billion or $2.48 a share, up from $2.03 a share a year ago, and revenue jumped to $51.73 billion from $43.8 billion a year earlier. Analysts on average expected earnings of $2.32 a share on sales of $50.71 billion. Their shares, though, fell more than 5% in after-hours trading on Tuesday, following the release of the results. In a note released in the wake of the report, Wedbush analyst Daniel Ives suggests the expectations for strong outperformance from Microsoft's Azure cloud computing platform and concerns about the company's forecast, which is expected to be shared later in a conference call, contributed to the decline. The stock is selling off after markets as Azure growth came in at 46% and beat the street at 45%, but was lower than some bullish whisper numbers of 48%, he wrote. Later adding, it all comes down to guidance on the call. This will be the focus for the street to gauge broader enterprise cloud spending into the rest of 2022 in this white-knuckle backdrop. Microsoft's earnings arrived a little more than a week after the software giant announced plans for the largest tech acquisition of all time, a $69 billion offer for embattled video game maker Activision Blizzard. Activision would add to the company's more personal computing segment, which includes the company's Xbox division as well as the traditional PC businesses, and established a quarterly record for sales at $17.47 billion, up from $15.12 billion in the holiday quarter a year ago. While Microsoft is largely known to consumers for Windows and Xbox, investors are keyed on the company's cloud business more in recent years. Microsoft reported record revenue of $18.33 billion in its intelligent cloud segment, up from $14.6 billion a year ago. Microsoft's other revenue segment, Productivity and Business Solutions, reported revenue of $15.94 billion, also a quarterly record. The segment that includes cloud software assets, such as Office, as well as the LinkedIn professional networking property, grew from $13.53 billion a year ago and beat the average analyst estimate of $15.88 billion. And elsewhere, international business machines rose by more than 5% after delivering a beat on both the top and bottom lines, though some of that growth was driven by one-off sales to Kyndryl. In other earnings news, General Electric fell 6% after reporting revenue that missed Wall Street estimates as supply chain disruptions weighed on performance. And Johnson & Johnson, meanwhile, reported mixed quarterly results as revenue fell short of analyst estimates, but the company projected its COVID vaccine could generate $3 billion to $3.5 billion in sales in 2022. Its shares were up more than 2%. Now, against a backdrop of historic inflation, the US Consumer Price Index rose in December at the fastest annual rate since 1982, and investors are getting concerned about just how early and fast the Fed will raise interest rates. Markets had priced in 3 rate increases in 2022, with the first in March, but noise is growing that more or bigger increases may be on the horizon. Billionaire hedge fund investor Bill Ackman has called for a shock and awe approach from the central bank with a greater than anticipated 50 basis point hike in March. And JP Morgan Chase boss Jamie Dimon sees 6 or 7 rate increases coming this year. This is all feeding into a significant spike in bond yields. The yield on the benchmark 10-year US Treasury note is at its highest since January 2020, touching 1.84% on Tuesday before settling to 1.82% and ended last week at 1.79% and began the year at 1.53%. None of this is good for stocks, especially tech stocks. The valuations of many high-growth technology companies bank on profits years into the future, and elevated yields tend to discount the present value of future cash. The steady rise in the 10-year yields since the beginning of the month maps to a decline for the tech sector, with the NASDAQ 100 down nearly 6% over the same period. Clearly, it's been a brutal start to 2022 for tech investors, as the tightening Fed backdrop and rising rate environment have catalyzed a major sell-off for the tech sector and is an ominous sign to kick off the year, said Dan Ives, an investment broker and investment bank Wedbush. In a note on Tuesday, many tech stocks are down 15+%, with some high multiple names down 35 to 40% to start the year. Yet Ives, who is among the most bullish of the tech bulls, remains so. The key debate on the street is if high multiple tech stocks can still move higher in a more hawkish Fed backdrop. He said the answer is yes. Ives outlined last week that he believes the coming earnings season will be crucial for the sector, with Wall Street needing to see upbeat 2022 guidance to get back behind tech. And he doubled down on that message on Tuesday. We view this as the most important upcoming earnings season for tech stocks in many years to turn the tide and derail the negative sentiment, Ives said. Wedbush expects very high growth rates, which may be revealed in financial results, and that will help justify tech valuations, with some $1 trillion in corporate spending planned for cloud software, among another boost. The underlying growth for the tech space is being underestimated by the street and will thus neutralize some of these perceived Fed tightening headwinds, the analyst said. But now back to Novogratz, the chief executive of digital merchant bank Galaxy Digital, who said that speculative assets like Bitcoin have fallen by around 50% from a peak seen in April of 2020, but thinks equity markets, which have been knocked considerably lower in recent trade, also has a lot more selling on the horizon. You've already taken your pain in crypto. You could take a little more pain in crypto, by the way, no doubt about that. And so the stock market hasn't had as much pain, Novogratz said. The billionaire investor says that he is looking at the small capitalization Russell 2000 index as one barometer of the market and believes that it could fall to 1,750 from its current levels, while the NASDAQ composite could possibly shed another 20% from its current slide. The technology-laden NASDAQ is down over 15% from its November 19th record peak, and the Russell 2000 is off 18.9% from its recent peak. That was back on November the 8th, with a further drop to Novogratz's predicted level representing a 28% decline from that November peak. We had an environment where the Fed was pumping in money non-stop, but we also had it where the Treasury was giving people lots of money. You had Treasury stimulus, you had Fed stimulus. That created a tremendous tailwind for asset prices, so growth equity stocks looked like they were going to infinity. Baseball cars, watches, crypto, said Novogratz. And that created in some ways a gambling economy, or at least call it a speculative economy, he said, referring to the speculative fervor. We have companies that have valuations that just seemed kooky, and we all got used to it, Novogratz said. He said that the market is moving to a period of some form of normality. Novogratz underscored that he's still wildly optimistic on crypto, but is maintaining a more sober outlook, with the prospect of building out the infrastructure for blockchain technologies that underpin the digital asset sector. We need more blockchains that go faster, that can process more, and we need a better regulatory framework, he said, and it's going to be a less speculative year where, as it was last year all felt like one big casino, he said. He said the crypto industry is flush with cash and that an influx of talent who can foster innovation. As for Bitcoin, he hopes that it put in a bottom at $33,000, but could see it trading in a range of $30,000 to $50,000 for the foreseeable future. And so if you stand back and think about all of this, you can once again see the problem that we face. On one hand, the economies around the world are slowing rather than booming, and that's despite all the stimulus. Inflation is still a problem, and now central banks are struggling with what to do. Should they raise interest rates? Should they pull back on their quantitative easing programs? Or should they just keep going? And as the markets begin to realize that perhaps something has got to break, the chances are that they'll continue to go lower. But that path, as with all paths at the moment, is set with more uncertainty. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.